Bitcoiners, welcome back to FedWatch. I'm just cutting Q straight off. I guess that's what's happening today. Cut off Alex, now cutting off Q, but we're going to just jump right into it. We have not talked about what is happening in Asia very much, and there is a lot happening in Asia. Yes, our last week's show was very much focused kind of on Western central bankers, Europe, IMF, the Fed. But now we're going to talk about China and Japan. I think I've been seeing a lot of headlines about Japan, and I've been seeing a lot of crazy videos from China. Ansel, I want to kick it back to you.
Yeah, big show with all that stuff. Before we kick off there is a huge meeting happening right now, and that is the FOMC. So they are meeting today and tomorrow, and they will be coming out with their policy decision tomorrow. So one day after we're recording live. Perhaps I'll do another midweek update for that, but I wanted to share my screen if I could, guys. Am I up for that? All right. Share screen. So just finding the proper thing here. And I want to show the likelihood of the decision here is pretty cut and dry. Everyone's saying that it's 98% that it's going to be a 50 basis point hike, 1% saying a 25 basis point hike, and 0% saying a 75 basis point hike. So we can, be pretty confident that that is going to happen. And by the way, this is the CME Fed tracker tool that is called FedWatch. So we might have to have a little talk with them about branding. Anyway, so stop sharing. Yeah, some big
cease
things
and desist.
Some big things also about the US. CPI is going to be coming out a week from tomorrow. So we'll have to be covering that next week as well. And the GDP number for Q1 came in negative. And I don't know if you guys have been talking about that on all your other live streams, but this is, the textbook recession is 2 quarters of negative GDP growth. So it's kind of a backward looking measure. But we could be smack dab in the middle of a recession right now. And this is why I think this period, these last maybe 4 weeks and then about 2 months into the future, very important for Bitcoin, very important for the global economy. I've been surprised with how well Bitcoin has been holding up in this wild time. So that's my intro. Do you want to talk about Bitcoin at all, Christian?
No, I honestly find moments like this where I really appreciate Bitcoin's strength is when Bitcoin is just flat and then like tech and Yuan are like falling off a cliff. So we're seeing like fears and slowdown of excitement in real estate. Looks like maybe a bubble is popping there. We'll see. But I love seeing Bitcoin's stability here. Like that's really where Bitcoin is very, very underrated, and you love to see it. You saw a little bit of that, kind of in early, after the big crash in March of 2020, where Bitcoin was just kind of like flat while things were kind of shaking out. But, it's really nice to see this right now. So good point.
Yeah, consolidating with all the geopolitical and global macro bad news, we still have good news for Bitcoin with the different countries and stuff, and we're flat. So this is a great time to consolidate for Bitcoin. And I think it's setting up a nice floor for the future. But anyway, should we go on to China? Let's get going with this. Okay, so China lockdowns continue in Shanghai. They are, right now, there's still about 4 million of the residents of Shanghai are under hard, strict lockdown in their homes. 6 million are prohibited from leaving their complex of their building, their residential area. And all of the city has some restrictions. This weekend, it looked like there could be light at the end of the tunnel because on Saturday and Sunday, they reported 0 new COVID cases or Omicron cases in Shanghai. And so everyone was like, oh my gosh, this could be it. We could start, ending the lockdown. But then Monday came and they had 15 more cases, and today they had some more. So the end of the lockdown in Shanghai doesn't seem to have any end. And also these new cases are in regions that were not heavily locked down. So it could be that more people enter into the hardcore lockdowns in Shanghai, and things get worse before it gets better. Going on to kind of the outcomes of
Wait,
this,
real quick, before we
yep.
jump into the outcomes, can we just say that on this show for the past 2 years, we've been talking about why all the pundits are wrong about China's success with COVID, and that they are actually setting themselves up for infinite lockdowns, whereas the West is, shaking it off and actually kind of almost becoming tolerant to some of these measures. So, I mean, I think we've been calling this dynamic for a long time. 2 years later, it is, I mean, sad to see, but it's also vindicating to see that, we were right in saying that the short term, good results of Beijing's policies, were not going to seem very favorable in the long term.
Yeah. And I mean, we've been right on China in many different ways as well. A lot of people were talking about China being the rising power and using that authoritarian model to, copy that around the world. And we're like, no, this is not a Thucydides trap. There is not this rising power of China and a declining power of the US. And we're seeing that play out right now. So the outcomes of this, so far in Shanghai, the freight traffic has plunged 81% in the last 3 weeks, year over year. So that's a very significant, obviously, amount. Now, nationwide, freight traffic is down 15%, and many of these areas are not restricted. So a lot of these areas down south into Shenzhen and Hong Kong and places, they're not experiencing hardcore lockdowns like Shanghai is, yet the entire country is down 15% year over year for freight traffic. So far, the lockdowns have spread to 48 cities. It's affecting 340 million people. And overall, 80% of the economy does have some form of COVID restriction on it right now. So there is still room to get worse. And we kind of see that going into Beijing. So Beijing's numbers have slowly started creeping up over the last couple of weeks. And they had citywide testing twice, I think, already this week. And if they were bad numbers, they are very scared that they could get a similar lockdown to Shanghai. So people have been hoarding food. They've been staying close to home, not going on trips, things like that. Because in Shanghai, it was a matter of hours in some parts of the city where they were told, get home, you're in lockdown. So the people of Beijing, they're, worried about that exact same kind of dynamic happening over there. Let's see.
Honestly, the people of Beijing are lucky that they kind of saw it be telegraphed in Shanghai, because, at least they could prepare. But again, the uncertainty, it's crippling, it's debilitating to society. And, the punchline is that it's questionable the measures even work, right? That's the punchline.
Yeah, they absolutely don't work. And I saw the number of symptomatic COVID cases in Shanghai. It's 750 symptomatic cases with Omicron, which is, obviously less bad.
I mean, it's effectively nothing.
Yeah. So they're doing all of this. They're crashing their entire economy for 750 people that have a flu type symptoms. I mean, it's pretty crazy. But I wanted to get into the PMI. So I wanted to share my screen again with the PMI. So this is the Chinese PMI. That is the Purchasing Managers Index. And you can see the last 2 months have just been down, straight down. 48, any number under 50 is contraction. And so last month was 48, and this month in April was 46. So it's accelerating into a contraction. I have another chart here that has a few more numbers. This includes manufacturing in white, new factory orders in blue, new export orders for factories, non-manufacturing, and construction. And you can see everything is headed downward at a fast rate. Now, this is different in my mind than if you look, 2019 into the original coronavirus, it was kind of trending up. Now, since late 2021, the PMI has been trending down, and it's now accelerating down at an increased clip. So this tells me that this isn't over. We haven't hit a bottom in China, and the economy is going to get a lot worse. So that's going to affect supply chains. That's going to affect CPIs around the world, and possibly monetary conditions. If they start easing dramatically, how is that going to affect global liquidity? So that's what I have some more charts here. Let's go into the Chinese yuan. Over the last couple of weeks, it has really started weakening dramatically. And a lot of people think that this is due to a currency manipulation. But if you look back in 2015, you can see that there's a very straight line. I know this is probably a small chart for people watching on YouTube, but there's a very straight line. And then all of a sudden they lose control and it pops up. But we didn't see that this time. So most likely this is not due to, strict devaluation of the yuan versus the dollar. It is a symptom of their easing and US dollar strength. So let's see what else other chart I have. Another thing, when you talk about China, you need to talk about Hong Kong, because obviously they have been increasing their control over Hong Kong. And I wanted to show this peg of the Hong Kong dollar to the US dollar, because it shows what a real good currency peg looks like. So at the top here is the top of the range, 7.85. And at the bottom is the bottom of the peg range at 7.75. Back in 2018 and 19, it bumped up against the top of this peg multiple times, but you don't see any wicks coming through there. Okay, that will be important later when I show you a chart of the Japanese yen and stuff. So there is no slipping out of this range, and it is under hardcore control. Okay, stop sharing my screen. Do you have any comment on that, or should we just keep going?
A lot of good information there. Now let's keep going. And again, really crazy to see, that few cases. And again, throughout this thing, China's always been known to be giving false information about, case numbers, et cetera, unreliable. So, who knows how reliable the information is, but whatever the case number is, they are shutting down in these cities. That's for real. The boats piling up in their ports is for real. And it's crazy to see that. And then on the flip side, we just continue to see the West open up more and more.
Yeah, I'm hoping to get the Huntsman from Twitter at Man Integrated on the show in the next couple of weeks, because he's a logistics supply chain guy. And because I want to pick his brain about what's happening. From my understanding is the boats or the ships that are starting to show back up in China, maybe from Europe or the US, they left before the lockdown started. So all the effects that are going to hit the supply chains have yet to really manifest in any way, shape, or form. And we're about to get the full frontal effect of these lockdowns. So I think that's interesting, just to see how there's a delay and why there's a delay from the lockdown starting to it affecting people all over the world, because it takes time for these ships to get around, right? To go back and forth between all these different ports. So hopefully we can get him on there and talk about that. All right, I have a real estate update also in China. We were one of the first shows in Bitcoin, probably the first show in Bitcoin, and one of the first shows in macro. I know I picked up on it from other people, but very few people were talking about Evergrande when we started talking about Evergrande and the Chinese real estate market. But despite their massive subsidies and their mortgage interventions, the market continues to slide. More and more developers are having trouble paying off their debts. The government, local and maybe provincial or the larger regional governments, are seizing property from these property developers still, and making it harder for them to meet their debt payments. So it's just getting worse. There have been multiple surveys. The largest 100 property developers in the country, their sales fell 52% year over year. And that was the latest reading before the lockdowns. So the lockdowns are going to crash that even more. Bank loans to the public have dropped as 50% as well. And another survey shows that 54% of depositors plan to save more money versus spend more money. And that is very important, obviously, in a debt-driven economy, and in an economy where they're trying to move from middle income to consumer spending driven. So if they're going to have their population cut back on consumer spending, there's no way they're going to jump out to be, they're going to be stuck in this middle income trap longer and longer. Now, the CCP has shown some signs of loosening the 3 red lines. This was the regulation that came out last summer that kind of kicked off all this insolvency and all the property developers. What they said was they're letting local authorities have a little bit of leeway on how to apply these 3 red lines, in their local area. So they didn't withdraw the 3 red lines, but they massively weakened them. So I thought that was interesting. Other than that, I haven't been paying too much attention to the high yield bond market. I know that they're selling for about 20 cents on the dollar still in these real estate developers. So that's pretty much bankruptcy level for all of these high yield bonds over there in China. And there is still a differential between how they're treating offshore debt versus onshore debt. They're not paying the offshore people. They are paying the onshore bonds. So this is going to affect their foreign direct investment going forward. And people that have parts of their supply chain, or companies that have parts of their supply chains in China, they're going to see how they're treating the different types of debt, onshore versus offshore. And so it's just going to, I think, exacerbate or accelerate the diversification away from China in supply chains. So do you have any comments on those things, Christian?
I mean, again, like, we very recently had Ray Dalio publishing, the beginning of the Yuan standard, the rise of China. We've had folks like Warren Buffett and Charlie Munger praise China, dump on Bitcoin multiple times in recent years. Where are they missing? I guess, like, just go a little deeper, because you're saying one, you've been right, but 2, you're saying, like, 1, they're 100% wrong, and then beyond that, there's actually going to be diversification away from China, that China is unsustainable where it is right now, and it's all going to fall apart.
Well, I was on the China bandwagon for a long time. I was a fan of Jim Rogers, and he was a big China bull for a long time. He said, you need to get a degree in agriculture and learn Cantonese. He said, then you'll have a successful life. But I think what people are missing now is that China is, one, in a dangerous neighborhood. And so they have to worry about all their different borders that they have. They have to worry about the authoritarian nature of their regime, that they only stay in power by, keeping the people down. And so all of that is an expense. So how have they been able to bend or grow over the last 20, 30 years? And I think it's just a big credit bubble. So when I look forward, I just see it harder and harder for them to maintain their standard of living and maintain this credit bubble from popping. So that's what I see. I just see China as one big credit bubble waiting to pop.
Is that credit bubble popping now, or will they be able to push the can down the road? It's crazy to see them treating onshore creditors and offshore creditors differently. Like, that can't be good for confidence.
Oh, absolutely. I mean, they're having a hard time getting banks to lend. And then I mentioned that stat about 54% of depositors plan to save more money instead of borrow and spend. And so people are starting to turn around and become more frugal with their money, and they don't want to borrow. So an economy that's driven off of credit creation, and you're having all these signs of pulling back on credit, that's not going to be good. Overall, I will say that their stimulus differs a little bit from the US. So we got our stimmy checks, right, direct to the people, where China likes to do infrastructure spending. They don't send out stimmy checks to the people. So those types of spending projects have diminishing marginal returns. You can only build so much infrastructure, right? The first piece of infrastructure you build is going to have dramatic increase in productivity. But as you go down 2 decades down the road and you're trying to continue to spend more and more on infrastructure, you're coming to the point where you're going to have negative returns. from building up the country even more. And that's one of the kind of critiques that people have had about China over the last 5 to 10 years is they are just overbuilt in so many different ways. And if they just keep pressing on this infrastructure pedal, something's going to break. It's not going to fix the problem. So I don't know if they will be able to push it off as long as, say, the United States has.
Well, again, we'll see. It's going to be really interesting to watch it all play out. And again, it's really interesting to see the China-Hong Kong dynamic and what that is doing with the Hong Kong dollar. We definitely need to continue to track that throughout the week. So I'm sure we'll get to it again in the show very soon. Do you want to move over to Japan?
Yeah, and this is a interesting kind of correlation is growing between Japan and the Japanese yen and the Chinese yuan. For years and years, Japan was more tied into the broader global economy with Europe and the US. And over the last, I would say, 5 to 10 years, it seems that Japan has been getting more and more exposure to China. They have been getting closer and closer financially. And we kind of see that in their currencies. So the Japanese yen is devaluing at a very quick rate as well, along with the Chinese yuan. And I have a chart of that. Let me just share this. So here's the Japanese yen. I hope you guys can see that. And it is over the last, I would say, month and a half, gone from 115 up to 130. And this is the highest that it's been in decades. If you look at the inflation adjusted number, so I tweeted this out this morning, but if you look at the inflation adjusted number, this is the real, quote unquote, real exchange rate. And it is at the most devalued or lowest for the yen in 50 years since 1971. And we all know what happened in 1971. So this is a big change for Japan. Even though their official CPI is still sitting at 0.8%, they're one of these countries that haven't really experienced the inflation that others have, but they're sitting at 0.8% in March. But they're kind of worried because the yen is devaluing so quickly against all other currencies, not just the dollar, but the euro and the yuan. Even though it's going in the same direction as the euro and the yuan, it's devaluing faster than those other two. I also wanted to share real quick the peg. So remember, I told you that we'd come back to that, what a real peg looks like, and what a not a real peg looks like. So this is yield curve control. And we all know that people out there in the macro space have been talking about how the US will eventually have to go to yield curve control in order to contain their interest rates. Well, Japan has a policy that they won't let the 10-year get over 0.25%. Well, they have broken that peg. And you can see over the last few weeks, it's gone up as high, I believe, as 0.27%. So not a lot, but you can tell the difference between this peg that's not really a yield curve control and this, where there's no wick coming out of the top of that Hong Kong dollar. So I thought that was very interesting and wanted to point it out. We'll see. They're worried about losing control of their economy.
Do you think they will lose control of their economy?
No, I watched a video this morning on a panel by some guys here. Let me get their names. It is Toru Sasaki. He's the managing director and head of the Japanese market research with JP Morgan in Tokyo and JP Morgan Securities in Japan. And Jesper Cole, he's the executive director of Japan-based Monex Group. And they had this panel discussion. They were talking about it doesn't look good financially for Japan, but there is a ray of hope that, Japan has been stuck in this malaise for 30 years. Since 1990, they've been stuck in this stagnation economy with very low inflation, very low growth. And this is possibly giving them the opportunity to roll that investment that they've had a lot of foreign direct investment into other places in the world over the last 30 years. This is an opportunity for them to invest back in Japan. And if they can do that, Japan will have a quick recovery. But they also say that in the near term, the yen could go up to 150. So I thought that was interesting, making some calls on Forex. But I tend to think that Japan is in a better position than China, but they are much more linked than they have been in the past. So Japan has to worry about if China falls off a cliff, then Japan could follow.
Why do you think Japan is so much more linked now versus in the past where it kind of had some more international relevance? Is it just because the malaise has gone so far that it just makes sense that they become more linked to their, their neighbors, and their biggest neighbor being China? Or like, I guess, why is this dynamic kind of playing out in your opinion?
Well, Japan used to be an important exporter, but that kind of changed with Fukushima. Around the time of Fukushima, they've now become a net importer. And that's one reason why I don't agree with when I say that the US's future looks like Japan over the last 20 years. And people say, oh no, Japan's different. They're net exporters. Well, they haven't been for almost 10 years. So this, Japan used to be a bigger part of the global financial system and the global economy because they were net exporters. But over the last 10 to 20 years, they have really invested outside of their country. So they've opened up factories for their automobile industry. They've opened up factories outside of Japan. They have slowly but surely gotten out of the carry trade. And I think they've gotten more invested with Chinese banks and Chinese real estate sector. So, that is how they become de-linked a little bit from the rest of the world and more linked with China.
So, of course, this is FedWatch, the Bitcoin and macro show. We've talked about with things looking bad with the euro and a strengthening dollar being everyone's enemy, that puts
Yes.
Bitcoin in the optimal position to benefit and to be the kind of universal safety blanket that people turn to potentially in negative situations. Does that
Yes.
also apply with China and Japan? We know that there's constraints in China now, given their aggression towards Bitcoin, but that hasn't stopped things. Like, is that the same situation?
I think it is. I saw somebody on Twitter saying that China was going to reverse their ban in 3, 2, 1. So it's getting to a point where these countries are going to have to adopt Bitcoin if they want to have any sort of growth in the future. And that's what I've been saying for a long time is when you look at the traditional legacy system, you look at how it's devolved and how it's stagnated and how it's all built on credit. And the best option or the best outcome is just stagnation. It's either recession or stagnation. Those are the two options you have with the traditional system. And so all of these people, including Europeans, including Chinese and Japanese, they're going to look at this new system, Bitcoin, as being red shoots and a place for growth and a place for expansion. So yeah, I think the same dynamic with chasing capital out of Europe and into Bitcoin is also going to be at play in China and Japan. Why that hasn't shown up in the price yet, we will see. We will see.
All right, interesting. Bitcoin stands to win. People stand to win from Bitcoin winning. That's a powerful cycle. We talk about Bitcoin as where there's going to be growth and that there are going to be two separate and competing ecosystems, economies, the legacy economy, and then the new upstart Bitcoin economy. And when you look at the vitals, health vitals for each economy, we see that the legacy economy, although it's much bigger, much more liquid, is showing signs of weakness everywhere. And every single year, Bitcoin's getting more and more healthy.
Yeah, it's more liquid at the best of times, right? But the problem is it's less liquid at the worst of times. And so Bitcoin offers that kind of hedge against liquidity drying up around the world. So I agree with the other system is bigger and more liquid, except when it's not. And that is the thing. I've been getting more and more on my newsletter on bitcoinmarkets.com. I've been getting more into what are some narratives we could push. And that's a big one, is that, Bitcoin offers a solution today. And it does the traditional system's job better in a lot of cases than it already does. Oh, you're muted.
Ansel, did you watch Jack Mallers' presentation at Bitcoin 22?
Yes.
So what did you think of his concept? Like, really talking about, let's talk about the Bitcoin network and how it competes against other networks today. I mean, I do think he's 100% right. And this isn't a new talk, when this has been something that he's been kind of pounding away at for a while.
What, be more specific? Sorry.
You're saying that Bitcoin's a better solution today. I think you mean monetarily and as an asset and as a store of value. But he's talking about like the network itself is a replacement for the incumbent systems right now. And he's trying to implement that with what he's doing in Strike. But obviously, other companies have, ridden waves that he's started to, and other people can kind of do similar things too.
Well, I think there's a little bit of confusion there between these two things. So liquidity and velocity are different, right? So yeah, there can be, I think Bitcoin's liquidity characteristics are pretty stable. You can always find a buyer for Bitcoin, and their Bitcoin does not have counterparty risk. So it's going to be much more liquid in times of credit crisis than the traditional system, right? Because the traditional system is pure counterparty risk. So I think that Bitcoin's liquidity characteristics in that sense are much more stable than the traditional system. That's why I'm saying it's kind of better today than the traditional system. Now, on the case of velocity and transactions and things, I think Bitcoin is ready to do it. Bitcoin is definitely ready to take over some of the roles of, say, day-to-day transactions. Like Jack Mallers is obviously doing excellent work on that side. I just saw a headline that I think it was from Bitcoin Magazine that Bitcoin transferred more value last year than Visa did, $13 trillion worth of value or something like that. So yeah, Bitcoin is ready. It's just a matter of getting more people have to hold it. More people have to want to hold it for Bitcoin to be used in transactions. So does that answer the question?
No, yeah, 100%. And I mean, I think with what Jack's doing too, he's even taking Bitcoin, the asset, away from Bitcoin, the network, beyond. But I understand 100% what you're saying from a liquidity perspective. And I agree. And I think that like Bitcoin's liquidity profiles is only going to get better exponentially from here. So like soon, and when I say hyper Bitcoinization is happening in this decade, people think that that's hyper bullish, but I'm just trying to think of like how much better Bitcoin is in practice. And then as more people get into it, how much better will it be able to compete with the existing system? And I don't think that, Bitcoin's going to be this underdog for very long. I think Bitcoin is actually going to be the superior methodology that people use very soon, and it's going to be obvious.
Yeah, one of the big, I guess, hurdles for the liquidity of Bitcoin is just the market cap. And I remember someone saying, it was some VC that said this years ago. I don't know if it was Mark Andreessen or one of these people, but he's like, the problem is just that I can't send big sums of money through it, right? So if the market cap back then, say, was 100 billion, you can't send $10 billion through the network. Same thing with the market cap, say, at $1 trillion. Some banks, some sovereigns, they want to be sending transactions in hundreds of billions, and that's just not enough room to send these large transactions. So that's why I say you need more holders, you need more demand to increase that market cap, and that gives room for these larger transactions. But on a liquidity side of, say, in the millions, not in the billions, but in the millions. All the transactions that happen that need liquidity in the million to 100 million range, Bitcoin has them covered. It's just when you get into the $1 billion range of transactions that Bitcoin's liquidity, has a ways to go. So that will come in time. The price is the only thing that matters. You need higher price to get more liquidity for these higher value transactions.
That is a good distinction, right? Like what you're saying effectively is like within this kind of like value band, Bitcoin's already better. And that's what Jack is taking advantage of, right? Jack has identified that, hey, within this value band, Bitcoin and the Lightning Network is already better than the existing system. I can tap into it right now and leverage that to serve this group of people. And then as that band expands with Bitcoin's market cap, then it opens up to more and more people. And I think that's when things get really, really interesting. And so this has been a great show. It's awesome getting to learn about the happenings in the macro and central bank level of things with you. I think you bring an enormous amount of alpha. Where can people learn a little bit more about what you do, your research, and where can people follow you?
So I'll just say up front here that I write a companion post to all of these episodes. So if you go to Bitcoin Magazine and you look for the companion post for this, it has much more detail with links and all of that. Sometimes I misspeak in these episodes. Sometimes I forget to mention something, and that is all corrected in the write-up. So go to Bitcoin Magazine to find that. I write a weekly newsletter on bitcoinandmarkets.com. I also have a pretty much weekly podcast now for Bitcoin and markets. So check out that website.
All right, y'all. Make sure to go follow Ansel everywhere. He's also on Twitter at Ansel Lindner, but go follow him in his real channels. I know he had a pretty good community going on for a while too. So you can definitely learn a lot from Mr. Ansel Lindner. You can find me at CK_snarks. This was FedWatch. We post this tomorrow on our podcast feed as well as on YouTube. So you can rewind this, listen to it again, watch it with the companion post. So that way you get all the details in full fidelity. But until then, I'm going to pass it back to Q.
One last plug, Ansel. What is the name of the newsletter?
It's a Bitcoin fundamentals report at bitcoinandmarkets.com.
Highly recommend Bitcoin and Markets. The newsletter is awesome. It's this in a lot more detail. So nerds like me appreciate it a lot. We'll cut to a quick commercial break before I try to sell you a bunch of shit.